Hey everyone, welcome back. Part 4, final part, I promise. I'll keep it as brief as I can. All right, so let's just do one of these calculations, a net present value calculation. You've got a project has an estimated annual net cash flows of $70,000 for 4 years, and it's estimated to cost $190,000. Ooh, you know what this is? $70,000 for 4 years. It's the same dollar amount. Guess what I get to use? I get to use the present value of the annuity table. I don't have to walk back every single year the way I did this one, right? Oops, not let me scroll. All right, and this one I had to walk back every single year to the current amount because of the different dollar amounts, the different cash flows. This one's telling me $70,000 a year. Fantastic. It means I get to use the present value of the annuity tables. Okay, so if I go over, my interest rate is 10%, and we're looking at 4 years. That's not what I want. All right, present value of an annuity. Here we go. Oh, 10%, next page. 10% and 4 years. 3.16987. See that? Okay, so I'm going to take 70,000 times 3.16987. And that is going to come out to be $221,891. Now, what is that? That is the present value of the next 4 years of payments, right? $70,000 a year from now, 2 years from now, 3 years from now, 4 years from now. I'm bringing them back to today's dollars. And today's dollars say that it's worth $221,891 is the present value of the cash flows, of the future cash flows. Okay, the investment is $190,000. So really, I'm ahead. Right? I'm going to lay out $190,000 today, if today's dollars, and I'm going to get returned to me over the next 4 years the equivalent of $221,891, which is I'm $31,891 ahead. That is the present value of the project. Okay? I think they ask you for the index too, right? The index would be 221. They have 900. I'm going to cheat. They rounded. I didn't round. They rounded 2 decimal places. So I'm going to cheat. This 221,891 is the same thing as their 221,900. Divided by the investment, and the present value index is then 1.17. Oops. There. Okay, so I hope that makes sense. We're going to move on. All I want to do is show you a couple things. I am not going to do your homework for you. I know you don't want me to do that, right? No, Professor Anderson. So what we're going to do is I just wanted to kind of call out to you that these are a little bit different as you go through to do the homework. So for this one, the example net present value method, it's one of your homework problems, says we're evaluating the purchase of a $150,000 piece of equipment having a 4-year life. The net cash flow is different every year, which means we cannot use the annuity table. Which means, for example, this first year, this $80,000, I'm going to have to go to the present value table, and I'm going to have to look at the period being 1, because it's 1 year out, and the interest rate is 15%. Now, when you do these problems, you can click that. That'll be a hyperlink. That'll bring you right to the tables. For me, it's a picture, so that doesn't help. Oh, and look at that. I don't even have 5 years on here. 15% on here. Okay, well, when you go to do homework, you'll see 15% will pop up in that table. Where am I? Okay, so you will have to go, I promise I got this number earlier. You'll have to multiply this times 0.87. That's going to be the 15% rate, all right? That's not in your index, but it isn't going to be in this hyperlink here. So you have to walk that back 1 year. This one, you're going to have to walk back 2 years to today's dollars, so it's going to be times 0.756. All right, that's going to be 2 years at 15%. All right, so you're going to have to do each one of these individually in order to come up with the present value. Because the dollar amounts are not the same, it is not an annuity. You can't use the annuity table. Okay, that's as much as I'm doing for you on that one. But I am also going to help you for this one, because this is another one that students have a sticking point for, that have some difficulty with. Okay, so I'll get you started, but then you're on your own. AM Express Inc. is considering the purchase of an additional delivery vehicle for $55,000. Truck's expected a 5-year life, residual value of $15,000 end of the years. The additional revenues from the added delivery capacity are anticipated to be $58,000 per year. For the next 5 years, a driver will cost $42,000 whatever, with an expected salary increase of $1,000 per year, and they're going to be operating costs from the truck of $3,000 per year. So the challenging part of this one is to come up with the cash flows are. What are the annual net cash flows from year to year? Okay, so I want you to think about this. All right, so the first year, 20Y1, that's how they have it. I want you to think about it. It's going to bring me an extra $58,000. Awesome. But I'm going to have some costs. Got to pay the driver, right? And I'm going to have costs of $3,000 per year every year of maintenance cost. So really, the cash flows in the first year are $13,000. All right, 20Y2, well, it's $58,000, but now my driver gets a raise, right? He gets $1,000 extra. So now you're looking at $43,000. And you still have $3,000 in costs on the truck. So now it's $12,000. Okay, see where this is going? The idea is that it's going to change from year to year. So you've got 20Y3, 20Y4, 20Y5. Okay, so each year you're going to have to be doing this. And the idea is that this is the annual cash flows that you're going to have to bring back to today's dollars. So you'll have to multiply that times the present value of 1 for 2 years, 1 year here, 2 years for this one, 3 years for the next one, and so on, right? To compare it to the cost of buying the vehicle of $55,000. Okay, now the place that, students tend to have trouble here, but one of the major points is in the last year. In the last year, you still have $58,000. You still have, let's see, his salary will be $44,000, $45,000, $46,000 in this year. $46,000 will be his salary because he gets a $1,000 raise every year. You still have $3,000 in operating cost. But you know what you're also doing in that last year? You're selling it. You're selling the vehicle. It tells you, where is it? That you are going to have a residual value of $15,000 at the end of the 5 years. So basically, you're going to have an additional cash inflow here of $15,000 in that last year. So last year will be $24,000. Or at least with my numbers, you're probably going to have different numbers. Because they're algorithmic, because that's how I assign the homework. Okay, so that's typically a sticking point for this problem. Not going any further on it. Oh man, I didn't mean to do this one. Okay, all right. You want the other one? I'll help you with the other one. If you don't want help, then fast forward me. Okay, I'm telling you right now, this is related directly to your, this is a homework problem. Okay, welcome in hotels, construction for new hotel, $90 million. Expected life of the hotel is 30 years, no residual value. Hotels expected to earn revenues of $26 million a year, but you're going to have expenses, including depreciation, are expected to be $15 million per year. You know what? I need to know about my cash flows. I don't need depreciation. That should not be part of my calculation. This is about your cash flows, discounting your future cash flows to today's dollars. Depreciation has absolutely nothing to do with cash, and that's the problem. Okay, so you know that you're going to be expecting annual revenue of $26 million per year for each year. So that's easy, right? 26M we'll go with. You're going to have expenses each year of $15 million, but you can't just subtract 15 because that 15 includes depreciation. So what we have to do is we have to calculate depreciation and take that out of those expenses of $15 million. All right, so you've got the hotel of $90 million a year. It's got no residual value, and it's going to be good for 30 years. So you're looking at $3 million in depreciation per year. So basically, in this $15 million number of expenses is also $3 million of depreciation. So we're going to pull that $3 million out of there, which means we've got $12 million in expenses. Cash expenses. So that means your annual cash flow will be $14 million. And I will give you a hint, it's $14 million a year every year So you get to use that annuity table, okay, to discount it back to today's dollars. All right, I'm wrapping it up, I promise. Last little bit. Internal rate of return. Told you we're not really talking about that. Okay. Uses present value concepts to compute the rate of return from a capital investment proposal based on its expected net cash flows. Does that sound familiar? Okay, it's kind of like net present value method, but looking at it from the opposite direction. I'm not going to get into the math on it. By all means, you cover it in a finance class somewhere along the way, but that's a little bit more than we do in here. Okay. You can grab the notes. The method, sometimes called the time-adjusted rate of return method, starts with the proposal's net cash flows and works backwards to the proposal's expected rate of return. So it's kind of like what we just did in reverse. I'd rather stick with our net present value method since it's the most popular one. All right. Other things. There are factors that we have not discussed at all that complicate these decisions. Income taxes. We kind of talked about them a little bit in that lottery example, but we certainly didn't go into the math, right? What if proposals have unequal lives? So like even that present value index stuff. We were looking at the calculations, but we weren't talking about like, what if one thing's going to last me 5 years, 2 years, 8 years? We didn't have that part of the conversation. What if there's qualitative factors, meaning not quantitative? Things like, well, we really need to expand this building. That's because it looks terrible, right? So qualitative factors. Okay, so there's other pieces to these equations. We're just focused on our analysis piece. That is what we're focused on as the managerial accountants in the room. Okay, the last just a term I just didn't want to miss in this chapter. It's capital rationing. It's overall, rationing is the process by which management allocates funds among competing capital investment proposals. So the idea is rationing. How much goes to each line, how much goes to each expansion, how do we decide who gets what? That's what this whole thing really is, this analysis, is capital rationing, deciding where management is going to allocate its funds. All right, we're done. We're done with this chapter. So let's move it along. Got one more chapter to go after this one. Congratulations on making it this far.